Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister. You'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, a CERO dealer. And now, here's your host, Michael Isbister.
Hello everyone, and welcome again to the Retiring Canada podcast. In today's episode, we're going to discuss how investment fees can drastically impact your long-term retirement plans. Specifically, I'm going to chat about understanding the fees you pay, advisory fees versus investment fees, 2 fees that are mostly transparent, 4 hidden fees that drag down your portfolio, a real-life example of how a hidden fee can disrupt a retirement plan, and lastly, as always, a few action items for you to consider. All right, I'll admit it, the title of this one is a bit edgy, and it will probably make a few people upset, especially the advisors out there who still utilize some of the products I'm going to discuss today. But hey, I'm not making this podcast for other advisors. I made it for you, the Canadian investor who can see the retirement dream approaching shortly, or the already retired investor who wants to make sure they're doing things the right way. So today, I want to talk about fees, specifically investment fees, what you pay to own your investment. Now, to best explain this, let's first start with another fee, the advisory fee or advice fee. This is what you pay your advisor for the advice they provide. And in my humble opinion, this advice should not only include helping you optimize your investments, it should also encompass all areas of your financial life. From goal setting, tax planning, retirement income planning, and estate planning, to name a few. In English, you want a financial planner that will help answer the big questions you have. Will I run out of money? And should I be doing anything differently? We display our value by not only answering these questions, but also through our clear, consistent communication and personalized service our cherished clients have come to expect. We strive each and every day to live up to this expectation we have set for ourselves and continue to raise the bar to enhance the client experience and provide a multiple of value that outweighs the fees we are paid. What are you paying for your financial advice? You can check out our fee schedule in the FAQ section on our website. But if that doesn't do it for you, I'll give you the quick and dirty. We charge 1% on households over $1 million, with that fee decreasing as your assets with us increase. This is called a fee-based model. Your fees are based on the assets we custodian for you. Now, I'm not here to argue what someone should pay for advice. We all deem the value of what we receive in different ways. It really is in the eye of the beholder, as they would say. However, if you're only receiving investment advice and nothing else, you may be getting the short end of the stick. Okay, so with that out of the way comes the title of this episode, How Investment Fees Are Ruining Your Retirement Nest Egg. Now, a bit of context before I start spewing out numbers. Investment fees are what you pay to own a specific investment, whether it be a mutual fund, alternative asset, segregated fund, or ETF. For those owning a hodgepodge of stock positions, you do not pay an investment fee per se, but you may be charged an annual account fee, transaction charges, and potential program fees. Now, when many of you listeners hear the word investment fee, some of you may assume I'm talking about the management expense ratio of a fund, also referred to as an MER. But what if I told you there are a number of other investment fees you're paying? Some of them disclosed when you look at the investment fund facts or prospectus, and others that are deeper within the fund, which inherently you will pay, albeit it doesn't show up as a clear percentage or number on any statement. Let's run through a short list of investment fees, starting with the ones you see. First is the management expense ratio I already mentioned, the MER. This is the most common number an investor will see, and chances are if you ask your advisor what you pay for the investment, this is the number they will rattle off. This is the fee charged by the mutual fund, ETF, or segregated fund, which includes administrative fees, operating expenses, legal fees, and management fees. The second investment fee is called the trade expense ratio, or TER, and this represents the annual cost of trading incurred by the mutual fund or ETF. This reflects commissions, transaction fees, and other costs associated with buying and selling securities within the fund. Now, when you look up an investment online, this number is usually not displayed on the landing page. Typically, it's just the MER. And there's a strong chance your advisor never mentioned it to you either. To find it, you actually have to look at the investment's fund facts. Another investment fee is called short-term trading fee. This is triggered by mutual funds when you sell or switch the investment within a set time frame. Now, while this is less common for people to actually get charged, it's important to know that you may be penalized if you change your mind within a set window of time. This can also be found in the investment fund facts. Now, let's shift gears and discuss other investment costs that happen within the investment that don't show up as a number on the fund facts. These have a very real impact on your investment return, unbeknownst to 99.9% of everyday Canadian investors. For lack of a better term, let's call these hidden costs. First are implicit trading costs. Now, while the trade expense ratio, or TER, I mentioned earlier, is a measurable fee, these implicit trading costs are a broader category and are more commonly associated with bid-ask spreads and the market impact a large trade may have on the price of a security. Now, to help make sense of this, pretend you wanted to buy a large amount of a single stock. The demand you place on that stock will actually increase the price of that stock. A simple supply and demand equation. Your demand for this stock limits the supply and increases the price. So, say a massive bank-owned mutual fund wants to buy a large position in a single company. They put in an order so large that it could actually incrementally increase the price at which they buy that stock. The impact of this purchase on the market and bid-ask spreads means that you, the underlying unit holder of the mutual fund, are left holding the bag, paying a higher price for the security. Again, while it doesn't show as a cost, you are potentially purchasing something incrementally more expensive than if you would have just purchased the investment on your own. The next hidden cost is cash drag. Within mutual funds, there is cash. This cash is not invested, meaning it's not working for you, earning a return. Now, while you may have cash in your investment accounts for specific purposes, that cash position is actually compounded by the amount the fund you hold allocates to cash. In many balanced funds, this could be anywhere from 2 to 5%. And if you have $1 million in one of these funds, that means that you have $20,000 to $50,000 sitting in cash and not in the markets. Why? Well, this leads me to the third hidden cost: securities lending. This is a practice done by mutual funds and ETFs. In its simplest form, the fund manager can lend the underlying securities within the fund to another institution. The fund manager would then charge a fee for lending the cash or securities. The fund who lends the securities receives collateral in exchange for the loan. Now, in most cases, the fund company will actually pocket this income generated from lending the securities and not pass it along to the underlying unit holder, you. Now, while this may be more of a missed income stream rather than a cost, it should be noted that there are a number of fund companies that actually redirect the securities lending income back into the fund to add to the fund's overall return. This is a big deal when you factor in an extra 5 basis points over a 20 or 30-year course of owning an investment. The last hidden cost I will speak to is tax. And to be fair, this isn't exactly hidden, as tax incurred by buying and selling within the fund is passed along directly to you, the unit holder. Now, I'm not referring to dividends or interest income here. Specifically for this example, I'm talking about capital gains, a tax that is paid when something is sold. But why are you paying tax from an investment you didn't sell in your investment account? Well, it's likely because the fund manager of your investment sold one of the investments within the fund. Perhaps there was a significant amount of growth in the individual holding that was causing the fund to be overweight that specific stock. Or maybe the fund company changed its mandate for that fund, forcing a bulk sell and rebalance, which triggered gains, which would then be passed along to you. Now, I know that this may sound a bit confusing, so let me tell you a real-world example of how I watched as clients were impacted by the choice of a fund company at my previous firm. In December 2021, the fund company changed the mandate in a few of their legacy portfolios that had been in place for decades. Many of the underlying investments had massive taxable gains attached, which were then forced to be sold due to the change in mandate. This taxable event was then passed along to the unit holder, materially impacting their taxes for the 2021 tax year. How material, you ask? Well, this specific mutual fund was trading at a net asset value of $13 a unit. And this taxable event triggered a capital gain of nearly $2.50 per unit. If I put this into dollars and cents, assume you have a $500,000 investment in this mutual fund at $13 a unit, so approximately 38,500 units. In December 2021, you would have been slapped with a near 20% distribution, working out to a $100,000 taxable capital gain, even though you didn't sell anything within your account. What's worse is for some retirees, this distribution then nullified them from the seniors drug plan here in Saskatchewan. And for others, they lost out on part of their OAS due to the clawback from this distribution. It was ugly. Needless to say, shortly after this event, we moved to an independent firm where we had the freedom to protect our clients from these kinds of mutual fund mechanics. Now, I've been harping on investment fees in this podcast, and for a very good, evidence-based reason. When we pay for something, we expect a certain level of value for what we pay. In case of investments, if you're paying 1% or even 2% for the investment, what are you actually receiving in return? Some may argue that they'll pick the best stock and be able to predict the market, while others may say they'll help protect the downside risk of the portfolio. But are these worth the costs in which you are currently paying? To these points, I would cite the annual research conducted by SPIVA, SPIVA, a report that shows over a 10-year span, 95% of Canadian equity funds underperform the S&P TSX Composite Index. And the same is for active Canadian fund managers with other geographic investment mandates. Furthermore, a 2010 study titled Luck versus Skill in the Cross-Section for Mutual Fund Returns from Eugene Fama and Kenneth French surmised that there is no evidence that trying to outguess the market price adds value. I've included links to both the SPIVA report and the academic journal in the show notes of the episode for you to see for yourself. At the end of the day, one of the largest predictors of investment success over the long run is based on the fee that you pay for that underlying investment. While in the short term, active management may do better than low-cost evidence-based solutions, over the long term, the investment fees I outlined today will erode your returns and stifle the compounding of your investments. Here's one last example to leave you with. Take two investments. One active managed fund with an MER and TER that adds up to 1.3%, and a low-cost evidence-based solution that costs 0.3% to own, a full 1% less in investment fees. Now, let's assume a $1 million portfolio and assume both of these investments earn a hypothetical 7% before investment fees. After 20 years, the actively managed high-fee investment would have an approximate value of $3 million, while the low-cost evidence-based investment would be worth approximately $3.7 million. A staggering $700,000 difference. Now, I don't know about you, but I think every investor in Canada, retirement age or not, should know this information. But the simple fact is these mutual fund dealers and big banks don't want you to know that you are being gouged. To help fight back, please be sure you're subscribed to the podcast and share the podcast with a friend or loved one that you want to protect from the long-term grind of high investment fees. Okay, so that'll do it for today. Here are your action items for today's episode. First off, if you want to know what you're paying for your investment, open up your statement and have a look at your fund holdings. Search the fund code or ticker to discover the MER you're paying. And be sure to click on the investment fund facts and add the TER, trade expense ratio, that you're not seeing. Alternatively, reach out to our team and we'll set you up with some feedback on your existing holdings and the amount of fees you're paying. Second, be sure to check out the links in the podcast description. If you aren't interested in reading financial journals, at the very least, visit the SPIVA website and check things out. For some of you, the information might be quite shocking. Third action item, if you want to know how we think about investing, visit our website and check out the investment philosophy page. Lastly, I want to wish each and every one of you a very happy summer. My family and I have a few Airbnb cottages set up for rental this year. I'm really looking forward to some downtime with my little boys and my beautiful wife. So your action item here is to make some time with family and make that a priority. Okay, so that'll do it for today's episode. Make sure you add us on all of our socials, LinkedIn and Facebook. For all the links that I've mentioned, check out the episode description in the podcast. If you're enjoying the show, please subscribe and leave us a 5-star review in your favorite podcast app. Be sure that you're signed up for the weekly Retiring Canada newsletter. And hey, when it comes to your retirement, don't take chances. Make a plan so you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.